My portfolio beat the S&P 500 by more than 6% in Q1 2026. Now, before anyone starts clapping like I suddenly became Warren Buffett with better hair, let's be clear. Some of this came from planning, some of it came from luck, and some of it came from owning the right boring assets at the right chaotic moment. While the S&P 500 fell about 4.6%, my portfolio gained around 1.8% on a time-weighted basis. That is a difference of roughly 6.5 percentage points. But the useful question is bigger than, did I beat the market? The better question is, why did this portfolio hold up when the usual stock and bond mix had such a difficult quarter? Because if you are building a retirement portfolio, especially one that needs to pay you real cash, this is where things get interesting. And markets can change. Over a full year, the S&P 500 can and most likely will outperform my portfolio again from a pure growth story perspective. Let me set the scene. At the end of 2025, my portfolio was fairly standard. I had VWRA as my main global equity ETF, I had EIMI for emerging markets, and I had IEAG as a broad bond fund. In normal language, this was a classic long-term investor portfolio: global stocks, emerging markets, and bonds. Simple, sensible, and honestly a little boring, which is often exactly the point. But my life situation was starting to change. I am planning to retire to Thailand around 2027 or 2028, but the signs are there that I could lose my job this year already. And the visa I'm looking at, the Thai LTR Wealthy Pensioner visa, has a very specific requirement. It wants passive income, actual income, money that arrives in the account. The target is 40,000 plus US dollars per year in passive income. Capital gains do not count. That detail matters a lot, because a portfolio can look large on paper while still failing to produce enough income for a visa requirement. At the same time, I also had another concern. US tech stocks had run very high valuation-wise in 2024 and 2025 due to the new emerging AI technology. A global ETF like VWRA looks very diversified from the outside, but under the hood it still carries a lot of exposure to large US tech companies. So even when you think you are buying the world, you may still be getting a very large serving of Apple, Microsoft, Nvidia, and friends. Delicious when they go up, a bit spicy when they all fall together. What I wanted was more simple. I wanted a portfolio that could do three things. First, it had to keep growing over time. Because retirement can last decades and inflation follows you around like an annoying subscription you forgot to cancel. Second, it had to produce real income, dividends, interest, cash flow. Money that can help with visa requirements and living expenses. Third, it had to depend less on one single market story. The story that US tech keeps carrying everything forever. Maybe that continues, maybe it does not. But I wanted my retirement plan to have more than one engine. Because when your entire plan depends on a handful of expensive companies staying perfect, the market usually finds a way to test your blood pressure. So I made a reshuffle. I swapped VWRA for VWRL and VHYL. VWRL is still a global ETF, but it pays out dividends. VHYL adds more focus on dividend-paying companies. I moved EIMI into SCDY, which is an emerging markets dividend ETF. And I split IEAG into IHYG, which is European high-yield bonds, and IEMB, which is emerging market dollar bonds. Now, let me translate that into normal human language. I moved from a portfolio that mostly relied on growth to one with more focus on cash flow. More dividends, more income, more value stocks, which automatically means less tech-heavy stocks. So more companies that actually pay money out. But changing a portfolio always feels uncomfortable. Once you move away from the standard global tracker, you start asking yourself awkward questions. Am I overcomplicating this? Am I chasing dividends? Am I reacting too strongly to expensive tech stocks? Will I look ridiculous if US tech keeps flying? Those are fair questions, and believe me, I'm asking them all the time. Every portfolio decision has a trade-off. More income can mean less growth. More dividend stocks can mean less exposure to fast-growing companies. More bonds can help with income, but they can still fall when markets panic. There is no magic portfolio where everything goes up, every dividend arrives on time, and the monthly statement gently whispers, "You are a financial genius." So the real question was, would this new structure actually help when markets go rough? And then Q1 gave me a very real stress test. On February 28th, the US and Israel struck Iran. Iran responded by closing the Strait of Hormuz. That matters because the Strait of Hormuz carries around a fifth of global oil exports. Oil prices jumped hard. Brent crude went from about $62 a barrel to over $128 within around 5 weeks. That is a huge move. The S&P 500 had its worst quarter since 2022, and bonds struggled as well. Why? Because inflation fears rose at the same time. Usually, people expect bonds to help when stocks fall. That is the classic 60-40 idea. 60% stocks and 40% bonds. Stocks fall, bonds cushion the blow. But during this period, both sides came under pressure. Basically, the market looked at investors and said, "Nice diversification you have there. Shame if something happened to it." So, why did my portfolio hold up better? 2 reasons: structure and timing. The structure helped because the portfolio had moved towards areas that benefit from inflation, commodities and real assets. SCDY, the Emerging Markets Dividend ETF, had large exposure to energy names like Petrobras and Saudi Aramco. So when oil went up, that part of the portfolio did well. SCDY finished the quarter up about 6%. IAPD, my Asia Pacific Dividend ETF, also helped. It has exposure to Australian miners and Asian energy companies. That was up 12.5%. The property funds IPRP and IWDP were up around 4 to 5%. And the small gold position, which is only about 1.5% of the portfolio, was up over 11%. That is the funny thing about small positions. Most of the time they look too small to matter. Then one day they walk into the room like a tiny bodyguard and actually do something useful. But timing also played a role, and I want to be honest about that. The reshuffle finished in March. That meant I was mostly out of the US tech-heavy VWRA before the worst of the sell-off. I did have a real concern about tech valuations, but I was sitting there with a spreadsheet, not a crystal ball and dramatic background music. If the shock had happened earlier, the result could have looked different. So I would call this a mix of good positioning, risk management, and luck. And in investing, luck is always in the room, even when nobody invited it. So what were the actual results? To make the numbers easier, let's imagine a $1 million portfolio structured roughly like mine. Looking at only the organic growth, meaning dividends, interest, price movements and fees, but excluding any new money added, the portfolio generated around $15,000 during the quarter. Out of that, just over $10,000 came from dividend income. And that dividend number matters most for me because dividends are the part that can help with the Thai LTR passive income requirement. The portfolio still has some distance to go, but it is moving in the right direction. And this quarter gave me 5 useful lessons. The first lesson, a global ETF can be more concentrated than it looks. VWRA is a great fund, but the top of the index is heavily weighted towards large US tech companies. So if you own a global tracker, it is worth checking what is actually inside. Because global can still mean very US tech heavy. The second lesson, dividends and value stocks can behave very differently from growth stocks. During this shock, they held up better. That may change in another market environment, but it shows that they can play a different role in a portfolio. The third lesson, small allocations can matter. Gold and property were small parts of the portfolio, but they helped more than their size would suggest. The fourth lesson, high-yield bonds are income assets with real risk. IHYG, my European high-yield bond fund, dipped about 0.5%. That is manageable, but high-yield bonds can behave more like stocks when people get worried about a recession. So if you hold them, understand the trade-off. They pay more income because they carry more risk. No free lunch, only expensive sandwiches. The fifth lesson, concentration risk can sneak up on you. Over the reshuffle, VHYL became about 24% of the portfolio. That is higher than I want. Once a single position gets above 20%, I start paying attention. VHYL may be a perfectly good ETF, but too much of anything can become a problem, even pizza. Well, actually maybe pizza gets a special exception, but ETFs definitely do not. So I will likely trim VHYL down over time. Now a quick word on the Bali property. The quarter was solid. March was the strongest month I have recorded so far, with 100% occupancy, generating an income of around $800 per month. Together with the ETF dividends, the total passive income is moving closer to the LTR target. There is still a gap, but the direction is encouraging. And that is important, because this whole exercise is about more than one good quarter. One quarter by itself means very little. The real point is that the portfolio structure matters, especially when you are investing for a real-life goal. A visa, a retirement date, a monthly income need, a country you want to move to, a lifestyle you want to protect. All of that changes the way you think. You stop asking only what gives me the highest return, and you start asking what does this portfolio need to do for my actual life. That is the big shift. If you found this useful, please like the video and subscribe to the channel. And let me know in the comments, what is your biggest portfolio concentration? Is it US tech, one ETF, one country, one property? I would be genuinely interested to hear what other people are dealing with. In the next video, I want to go deeper into something I touched on today. the visa rules, because the Thai LTR visa did more than influence my retirement plan. It shaped the portfolio itself. The income requirement, what counts as passive income, where the money is paid, what gets taxed, what gets ignored. All of this matters much earlier than most people think. And this goes beyond Thailand. Many retirement visas around Southeast Asia and beyond have similar rules. So in the next video I walk through how visa requirements can quietly shape your investment strategy long before you actually move. Have a fantastic day and see you in the next video.